Venture capital has experienced significant evolution in fund sizes and investment trends over the past decade. Understanding these dynamics is crucial for both investors and entrepreneurs navigating the modern startup ecosystem. Over the past decade, the venture capital industry has experienced a significant evolution, particularly in the size of the funds being raised. Between 2013 and the fourth quarter of 2023, the average size of a VC fund nearly doubled, climbing from $84 million to approximately $153.8 million. Several key factors have contributed to this remarkable growth. One major driver has been the increased inflow of capital into the venture ecosystem. The sustained tech boom, coupled with the rise of high-growth startups across various sectors, has drawn substantial interest from institutional investors, family offices, and high-net-worth individuals. With confidence in the potential of emerging technologies and business models, these investors have committed larger amounts of capital to VC firms. At the same time, the demand for larger investments has grown as startups scale more rapidly than ever before. Companies are now able to reach significant milestones in shorter timeframes, but doing so often requires considerable funding. In response, VC firms have raised larger funds to ensure they can meet these heightened capital needs and maintain a meaningful role in their portfolio companies' growth journeys. The increasingly competitive landscape has further fueled the trend. With more VC firms vying to invest in the most promising startups, having access to larger pools of capital has become a strategic advantage. Bigger funds enable firms to offer more substantial investments, which not only strengthens their ability to win deals, but also makes them more attractive partners to ambitious entrepreneurs. The increase in VC fund sizes carries important implications for how firms operate and invest. First, it has prompted shifts in investment strategy. Larger funds often need to target later-stage companies, where the ability to deploy substantial amounts of capital in a single investment is more feasible. Alternatively, some firms opt to invest across multiple stages, supporting companies from early development through to maturity in order to allocate capital efficiently. Additionally, the growth in fund size brings heightened pressure for significant returns. With larger pools of capital comes the expectation of securing proportionately larger exits. VC firms must therefore be even more selective, focusing on startups that not only show strong growth potential, but also have a realistic path to delivering outsized returns. Finally, there is the risk of potential overvaluation. As more money chases a finite number of quality opportunities, company valuations can become inflated. If startups are unable to sustain the growth implied by their valuations, this dynamic can expose both the companies and their investors to considerable downside risk. A prominent trend is the rise of mega rounds, funding rounds exceeding $100 million. In 2024, such mega rounds continued to account for a significant portion of venture capital investments, particularly in sectors like biotechnology and artificial intelligence. Venture capital thrives on innovation, and while some firms specialize in specific sectors, others take a more generalist approach, investing across a wide range of industries. Among the most prominent drivers of funding growth in 2024 has been artificial intelligence, which played a pivotal role in the overall increase in global venture capital funding. In the second quarter alone, total VC funding rose by 5% compared to the previous quarter, reaching an impressive $94 billion across 4,500 deals, with AI investments standing out as a key contributor to this surge. Meanwhile, the biotechnology sector experienced a significant resurgence, with funding climbing from $21.2 billion in 2023 to $28.1 billion in 2024. This momentum was fueled not only by increased venture capital investments, but also by a notable rise in IPOs and mergers and acquisitions of private, venture-backed biotech firms. While AI and biotech continue to dominate the conversation, venture capital remains a dynamic field where both specialized and generalist investors seek to identify and support the next wave of groundbreaking innovations across a wide spectrum of industries. While Silicon Valley remains a dominant force in venture capital, other regions have been making significant strides, reshaping the global investment landscape. Europe, in particular, experienced a surge in venture funding during the second quarter of 2024, with European startups raising $15.6 billion, a 14% increase from the previous quarter. The UK tech market led this growth, attracting substantial investments in financial services, clean tech, and artificial intelligence. Spain also emerged as a standout, achieving a record €4.07 billion in fundraising during 2024. This growth was fueled by substantial public initiatives, including Fond ICO Global and the Next Tech Programa in Viert, which played a crucial role in attracting capital and fostering innovation. As venture capital expands beyond traditional hubs, both established markets and emerging ecosystems are demonstrating that innovation knows no geographic boundaries. In response to the evolving market conditions, investors are adjusting their strategies, focusing on profitability and supporting emerging managers. Recently, it has been observed a shift towards prioritizing profitability over rapid growth, with investors favoring sustainable business models. Also, funds like GCM Grosvenor's Elevate strategy have raised substantial capital to back emerging and diverse managers, indicating a trend towards diversifying investment leadership. The venture capital landscape is characterized by increasing fund sizes, the prevalence of mega rounds, and sector-specific investment booms, particularly in AI and biotechnology. Geographical diversification and evolving investor strategies further underscore the dynamic nature of the industry. For stakeholders, staying attuned to these trends is essential for informed decision-making in this ever-changing environment.